Well, the drop in the stock market over the last month has taken its toll on investments intended for use during retirement, causing a difficult tax issue for descendants' estates. Fortunately, there is a valuation provision that can be beneficial. Roger McEowen with the Washburn University School of Law now joins us for this week's Rural Money segment. Roger, as always, thanks for chatting with us today. Let's start with the valuation basics and how they can benefit farmers at this time.
Right, Janet. This is, and good to be with you. This is a provision that actually was very useful in the major downturn in the market in 2007, 2008, in that time frame. And here we are back again with this. What this is a federal estate tax valuation provision for people that die at an unfortunate time concerning the market. So usually the valuation of an estate is done as of the time of death, and you pay tax associated with what that value is. However, if values go down within 6 months after death, you have the ability to make an election, the executor does, in the decedent's estate to value it at that lower amount 6 months later. So for people who had a taxable estate, say and died last September or so, the market peaked about February 12, and it's been down significantly since then. So they could value that 6 months after death. So if you get into like a March valuation because of a death last fall, then you can value it at a value that would be about 30% less for those stocks that were contained in that estate. But the estate has to be taxable, and it has to have a lower value 6 months after death than it did at the time of death to be able to make this special election.
So walk us through the application of the alternate valuation election that you're talking about.
Yeah, let me just give you a real quick, simple example. Let's say we had a person that died in the middle of September last fall, had a taxable estate of $15 million. At the time of her death, let's say she had an available estate tax exclusion of $11.4 million, and that's what it was last year. Well, if we assume that the tax liability in her estate would have been $1.44 million, if she values it after the market plunge, which knocked out about a third of that stock value, let's say it took her estate value down to $12 million from the $15 million 6 months after death, the result is that that estate is going to save about $1.2 million in federal estate tax because of the election to value the property 6 months after death. So it's a very special rule that only applies in situations like we're in right now. But if this is a farm or a ranch estate, for example, the ability to save $1.2 million in federal estate tax just because of this timing issue can be absolutely huge for the continuity of that business going forward.
How does the matter of included and also excluded property play a role in all of this, of course?
Well, that is a term. Those terms apply to how you actually apply the election. Some things are easy to value. We know what the value is at the time of death. We know what the value is 6 months after death. But sometimes we're dealing in an ag estate with, say, a crop that is planted shortly before death, and it's harvested and sold within 6 months after death. Or perhaps you had somebody that had cows that were bred before the date of death and then calved after death and were sold after the 6 month period following death. We get into concepts that tell us how we value those unique things, and that's what the details of this election involve, included and excluded property. So it has to do with what you include in the calculation and what you don't.
Roger, what would you see as the big takeaway that folks need to write down right now?
Well, this is a very uniquely tailored concept. If you did have a family member that happened to die last fall and were still within that 6 month period, and you had a substantially higher value and the estate was taxable, and now you've got a much lower value, you have the potential to save a great deal of federal estate tax. And so you need to be talking to your tax attorney, perhaps your CPA, that can then get in touch with the attorney that's handling the estate to see if this election is possible. If it is, it can save a lot of money.
Roger, as always, thank you very much for your insight today. Roger McEowen, he's with the Washburn University School of Law, on the phone with us today from Topeka, Kansas.